What's going on, everybody? Happy Friday. I am back with Padi Goodspeed, and we are here to break down the jobs report. And what the heck happened, Patty? Yesterday, I thought it was going to be smooth sailing. Well, not smooth sailing, but I thought it was going to be a little bit better than what we anticipated. It seemed like everything was going in the right direction, and we completely blew past all the jobs numbers today. And what does that mean for everything going forward?
Well, I mean, I think I tweeted this morning that in 2 decades of being in this business, the one thing that has been the most common is that initial reactions are usually wrong. So I think people are reacting significantly. The market reacted very significantly to this job report today that indicated that there were 263,000 new jobs created in November. Well, this report had a lot of contradictions to the ADP report that just came out yesterday. So I think as soon as the bond market, just as soon as the bond market figured out what was going on, it started to bounce back. And let me tell you exactly what I mean. So I'm going to go on here for the and give you guys some numbers. Okay, so when the market opened today, it was like, oh my God, the bond market was down 73 basis points. And I was like in my slumber, like, what is going on? And then I thought, oh my God, the jobs report. So by right as of this conversation, we're up 45 basis points, which means essentially it's recovered. Why did it recover? Because this job report seems to be it just doesn't feel accurate or depicting something that's really going on. This is just some big illusion. And specifically in the manufacturing division of the report, you saw that there in the ADP report it was 100,000 jobs lost. In today's report, the jobs were gained in that sector, and that sector is experiencing a recession nationwide. So when you actually look at first the market responded to the data, then
Mhm.
then we said, wait a minute, let's analyze this data. And when we analyzed the data, the bond market went from being down 73 points to being down a total of 28 for the day as of this recording. So we have to always make sure that we look at these responses, especially in this last 6 months of sheer volatility, and just look at what we're looking at and make sure it's accurate. And it's interesting. It's so crazy. Earlier this week, you had James Bullard, who is they call him the Raging Bull. He's one of the presidents of the Federal Reserve out of St. Louis. And he just opens his mouth and the market responds. And a couple weeks ago, he had said that he wanted the feds to hike rates up to 7%. And the market just reacted crazy, like, oh no, these guys are not going to slow down. What's going on? And I'm just thinking to myself, are you guys, what is going on? There's a huge reaction whether a Fed chairman or president or a voting member speaks, and then there's a huge reaction in the markets. These reports come out, and despite having a significant amount of contradicting data, the bond market reacts and people react like, oh no, interest rates are going up again. So
Mhm.
as of yesterday, the average 30-year interest rate had been marked at 6.29%. And as of today, as a result of this report and after the dust settled, we're looking at an average of 6.39. So there is very little movement in the bond market as a result of this news. This news
That's
is
good.
contradicting of the ADP report that came out yesterday. And we have a lot more work ahead of us in terms of inflation, but we can expect the unemployment numbers might slightly continue to rise, although the employment sector has been really resilient in the middle of all of this drama. So
Mhm.
the unemployment number was unchanged at 3.7%. So it just
Mhm.
kind of makes you wonder, like, what's going on?
Yeah, totally. And I mean, I was doing some research last night, and I want to talk maybe a little bit more specifically about the manufacturing jobs that you were alluding to, because, like you said, you said that sector is going through a bit of a recession, and so I guess it all ties back into if the Federal Reserve depends on how fast they want to bring down interest rates, right? And they have to be careful with that because people's wages aren't going up. And if we see more companies that can't afford to pay workers or keep workers, then those industries start to go into recession. And one of the ones that was highlighted specifically was the manufacturing industry, which I think that me personally, I think that we're in a really weird place where we've developed robot technology to the point where maybe we could see robots in the workforce in a not too near distant future, and companies can use that money to then cut on cost and save on overhead by just having machines essentially working, but that doesn't work for every business, but for some it obviously can. There's a bunch of issues that come with that, but that's for a different time. But let's talk a little bit about the manufacturing recession that you said, and can that go to a services recession? Because that is where now my thinking is going, and my like fears are kind of being realized, where is what happens if we bring down inflation very slow and we see kind of a recessionary landscape across the board? Does that make sense?
Yes, but so how are you defining a recession, right? So
Right. Well, that's
that I
another
think is the biggest problem, or the biggest hurdle to answering your question directly is how are we defining a recession? Because many people would say that we're already in a recession. We're already dealing with high inflation in the middle of a recession. And I think that we're seeing that with the savings numbers go down, right? So if we're
right.
looking, we're seeing that. So the biggest concern is, and I think that Jerome Powell has said this repeatedly. I watched his most recent
Hmm.
speech multiple times.
On
He's
Wednesday, yeah.
yeah, so essentially what we're worried about is that the American people, for all their dollars, are being worth less. And the issue that we're seeing is a lot of contradicting data in the economy that is suggesting that how can unemployment be resilient under 5% if we're in a recession? And I think
Hmm.
that's one of the biggest indicators that we need to watch for. So I think the inflation numbers will continue to go down. And we think
Hmm.
that mortgage rates will continue to go down in
Hmm.
2023. So we might see an average interest rate of between 5.5 and 5.75% in 2023 across the board. Many people are predicting even higher than that, which I don't understand why, if they expect that the inflation figures are going to go down. So I
Hmm.
think I don't know how to answer your question, because there
Hmm.
are several economists that are well versed and they're loud and they're wrong. So I don't think there's a proper way to predict. I think we can predict on a day-to-day basis, on a week-to-week basis, based on how volatile things have been, and also the contradicting nature of the housing market being so resistant and resilient, and the job market being resilient despite the shift in the interest rates and the tightening of the monetary policy. So I guess to answer your question is, I don't know. I don't think anybody knows. And I think people that say
Sure.
that they know don't know what they're talking about. We just
Right.
don't know what's going on. What I do think is that the Fed has made a very strong stance that they're going to be looking at data in between meetings, in between these Fed meetings, and the data that's coming in is promising, and it's showing that the inflation numbers are moving. And as long as that continues, despite the resilience of the job market, then I think we're going to have demand pick up in real estate, and I think buyers, we can see that how home prices will be stable. I think what we
Hmm.
want to avoid in our sector is this massive prediction of 30% crash in real estate prices,
Right.
which again, I don't understand where that could be coming from. So I think
Right.
we're, from you and I's professional perspective, it's not a bad thing to have a resilient job market. We need people to be employed, and we want people to be employed for the economy to be healthy. But what the word is that there's still a lot more room for unemployment to rise without our economic, without having a huge crash economically. So what is a recession? Are we in a recession or are we not in a recession? What does it mean if inflation remains high? Inflation is likely to remain high throughout 2023. And what is high? High is the core inflation number came in last at 6.3%. I could have sworn that Jerome Powell called the inflation numbers below 6% in his meeting. I didn't know what that meant, and I thought, we'll wait to see what happens on December 14th when he further
Hmm.
explains his position. So
Hmm.
if the inflation numbers are going to come down, then they continue to hike rates. They're going to continue to hike rates. They're just not going to hike at the rate of 75 basis points, which
Right.
means they will continue to aggressively try to slow down the economy, which means that it's inevitable for the unemployment rate to rise over the next few months. We just have
Hmm.
to see how it plays out before we can really give an educated answer on what you were talking about.
Right. For sure. So let's switch gears just a little bit. And something that I think a lot of people need to understand is that I didn't really understand until 2 weeks ago is that rents are actually tied into core CPE or core CPI. There is like a rent basis, right? That's like rents are actually part of inflation. So as inflations go down, rents go down. Is that correct?
Rents have already been going down. That is a
Right.
promising factor. And in some cases, those figures are removed to get the core inflation number is what you're looking at. That's what you
Right.
want to see change. Yes.
Right.
And rent has been going down for the first time in many, many years. I think the first time in 7 years.
So if rents are going down and inflation's going down and mortgage rates are going down, um, where does that leave the investors that are like going to buy a house and or a condo and say rent that out, right? And their mortgage payment now as investors is they can pay way less than what the rent is because the rent's going down, so their mortgage payment's going down, the rent's going down, so the money that they're going to get, their ROI on the money is shrinking, but their payment is also shrinking. So like what is your advice for investors during like a kind of deflationary period like we could possibly be going through in 2023?
Well, I think that I saw an operator who I think manages about $400 million worth of multifamily say something like, if you are at 100% occupancy advising other operators, then your rent's not high enough, right? And I
Hmm.
think that there are a lot of investors that own properties right now that probably haven't even hiked rent in 2 to 3 years. Let's say they haven't raised rent. So if you're a brand new investor and you're coming into the market and you're looking at what's happening with the economy, then you have to, this is what I've told every single aspiring Airbnb investor, short-term or long-term investor. I've been very frank with them to say, if you think you're going to be raising rents in 2023 or taking higher than market rents because of demand in 2023 and 2024, you're betting against yourself. You're wrong. So then you had people that were making a lot of money off of Airbnb and other short-term rentals in areas that typically wouldn't have the demand, just simply because of the nature of the world over 2019 and 2022, where remote work became more popular and
Hmm.
people were traveling to various places, and Airbnb was a
Right.
viable option.
Good
So
point.
right now, if your short-term rental is not strategically located, maybe oceanfront, maybe downtown, maybe somewhere very fabulous city, remote, whatever those
Mhm.
key locations are, then you're not going to probably see the earnings that you saw in 2021 and 2022. That's just basic simple logic, right? So if you're a
Hmm.
brand new investor coming into the game with short-term or long-term rental aspirations, then you would do what I'm telling every buyer or investor to do when they're buying. If the investor is buying, you're not going to buy the house that hits the market, that was fully renovated, that has every nook and cranny touched up, and it's in its stage to sell. That property is going to get 10 offers in the first 7 to 10 days, and it's going to sell in under 30 days. You're going to go after the property that's been sitting on the market for 17 days with no offers because the seller didn't have the means to prep it. And if you think that home prices are going to drop by 10 to 15% in 2023, then you're going to offer 10 to 15% below the list price because you're going to try to negotiate and you're going to get yourself into those terms. And you're going to make sure that that your down payment is high enough so that you can have either a break even or a cash flow point for the property. Otherwise, you got to sit this one out. So I
Right.
think that there are way too many investors that came into the game thinking that they can raise rates. And if you're in California listening to this, you already know it's extremely difficult to get cash flow in California. The mortgage payments are higher than the rents in most cases. I
Hmm.
tend to have positive cash flow throughout properties, but I invest outside of California. So it depends on how much are you going to put down, how patient are you going to be, what properties are you seeking out, and how much capital you have. And I think that's why during a recession, they say it's so important to have capital and have cash and have availability to be able to make the investments, whether it's a larger down payment to create the cash flow or to be able to buy something that needs a lot of work so that you can get a better deal on it and put a regular down payment and still be able to properly cash flow. So
Hmm.
investors, of course, you can't bet on raising rent forever. Anyone who's been around long enough will tell you that. But this is the moment. If you're new to it, getting into it, then you know that rents can't continue to go up at the average of 6.1 to 7% that they were going up per year. That's unrealistic. So and also right now, if you have lots of incentives from various places to attract renters because there's less demand. Why is that? Because of their job process. So one of the things that's happening with the job economy is that when someone gets laid off, they're having a harder time getting hired and finding a new job. That's why
Mhm.
they're staying at their jobs now. There's less people leaving the job to start a new job. This little section of the equation matters as well. So people are getting laid off and they're having a harder time finding a new job. So that means they're more likely to stay put in the lease that they have as opposed to upgrading or moving to a more convenient location, or I want one more bedroom, right? So people will stay in their lease longer, and then you want those people who are paying on time to stay there. You're certainly not going to increase the rent on them unless you want them to leave. So I think a lot of people in 2023 are going to look for cash flow stability as opposed to hiking up rents because the demand isn't there.
Hmm. Interesting. Well, I really appreciate your time, Patty. I know that this was very brief, but I know we're both short on time today. And then real quick, in a minute, if you can, just give us kind of expectations, what to expect. Do you think next week for Jerome Powell? Do you think it's going to be a 50 basis point hike, like a lot of people have been saying, or what are your thoughts?
I'm willing to bet you that we will have a 50 basis point rate hike, and we're going to see mortgage rates improve next week, even just a little bit,
Hmm.
but it's going to happen. That's the thing. The sentiment next week is going to be the pivot from the feds that everyone's been waiting for, a 50 basis point rate hike and a small improvement to mortgage rates. And if I'm wrong, hey, I'll eat my words, but that's my bet.
Awesome. Well, we'll look forward to that next week, and I really appreciate your time. Um, Next time, let's try to make it a little bit longer. But thank you so much for taking the time out of your day today to come and educate people. This has been really meaningful to so many people. I've gotten so many good comments and feedback. So thanks
It's been,
again, and we'll see you on the next one.
thank you so much for having me.
All right, bye.
Bye.